So you're a beginner with options trading, and you want to know the number one thing I would do as a beginner to make money with options. It's not buying, it's not hoping and praying, and it's not guessing. This is a very safe way that you can step by step systematically make money on your money without hesitation. This strategy is called cash secured puts. Let's get into it. So, what actually is a cash secured put? There's three ways to describe it. Way number one, getting paid to wait to buy a stock you want to buy anyways. Way number two, how to actually generate weekly income from the market, whether you determine or want to buy stocks or not. Way number three, a way to lower your cost basis in any stock you already own. So those are three usual reasons people do cash secured puts. But what actually is it? Well, in the world of options, it's actually a situation where you go from buying options to actually selling options. Let me pull up a chart and we'll go more in depth. So when we talk about cash secured puts, what are the three items we talked about? Well, number one, we talked about people doing that to generate cash flow. Number two, we talked about people doing it to get into stocks cheaper that they could at the current price. And number three, we talked about people doing it to reduce their cost basis in a particular stock. For those who don't know, a cost basis pretty much means your price per share. So for example, if you bought $100 worth of stock of Apple when it's at $100, and then you bought another 100 shares at $50, your cost basis is now $75. It's the blended of the two. So that's what people do. When they do this, when they sell cash secured puts, they do this for one of these three reasons. But at the end of the day, all of it boils down to cash. When you get paid cash, you can get into stocks for cheaper, you can generate cash flow, and then you could also reduce your cost basis, all because you're getting paid to sell a stock. Now, before I get into exactly what this is and how to implement it, you need to understand certain rules about options trading, and there's four of them. Every options trade has similar components, one of these four components. Component number one, it has an expiration date. An expiration date, just like any contract, is when the contract expires. Number two, it has a strike price. You can think about strike price like the stock price itself, or the stock price you think the stock is going to get to or not get to. Number three, it has a premium. A premium, it's what's paid or received as opposed to getting to an options contract. And number four, you have to worry about calls and puts. These are the basic ingredients or the elements when it comes to options trading. Now, the beautiful thing about this is there are two sides to this. Like I always say, you can buy or you can sell. But here's the thing, depending on what direction you think the market is going to go, that's what determines what you're going to do. For example, calls can be used if you think the market is going to go up or whether you think it's going to go down. So for example, if you think the market is going to go, if you think the market's going to go up, you buy calls. If you think the market's going to go down, you sell calls. If you think the market's going to go down, you buy puts. If you think the market's going to go up, you sell puts. So this is for up, if you think the market's going to go up, and this actually if you think the market's going to go down. This is your triangle. This is your basics. On the left side, if you think the market's going to go up, you can either buy calls or sell puts. On the right side, if you think the market's going to go down, you can either sell calls or buy puts. Here's why this makes a difference. On the buying side, when you're buying, you're the one giving up the premium. That's the first thing that's not the issue, but the downside of this. So when you're buying, you're the one giving up the premium. You're the one paying somebody else. Number two, when you're buying, time works against you. So if the stock doesn't move in your direction, in your favor pretty quickly, time works against you. And number three, when you're buying, it needs to be a lot of volume or momentum, because if the market stays the same, guess what? You're still going to lose money. But when you're selling, it's the opposite. Okay. But before we get to that, here's the pros of buying. Buying is for multiplication. So your calls when you buy or your puts when you buy can go up exponentially. When you're selling, you don't get exponential growth. You get a fixed maximum profit. So when you buy a call, if it goes your way, what you paid for the call should be the cheapest it should ever be. So if you paid $200 for a call, you want it to go to 50 million or infinity. Okay. So what you paid is what you wanted to the cheapest to ever be. But when you sell, it's the opposite. When you sell, what you get is the most you're ever going to get paid. Is the most expensive it's ever going to be, or that's what you hope for. So when you sell, if you get paid 250, that's all you're making on that trade. Even if the market, let's say you sell a put and the market rages to the heavens, the max you're still going to make is going to be 250. And remember, when you're selling puts, you want the stock to go up. So if it goes up and it keeps going up in your favor, when you're selling puts, you don't make more money the more it goes up. But when you're buying calls, you make more money as it goes up. So buying is for multiplication, selling is for income generation. I will say that again. Buying is for multiplication, selling is for income generation. Other side to this is that when you're selling, the pro is not only do you get paid the premium, but time works in your favor because there's an expiration date in your contract. The closer and closer it gets to your expiration date, guess what? The more the trade works out in your favor. As I can go to a grocery store and there's a piece of chicken and there's an expiration date on that piece of chicken. In a grocery store, they might offer you a discount for buying it. In the stock market world, the closer it gets to expiration, it's the opposite. The less valuable it actually is. So you get to keep all the money they paid you up front. Okay. So that's the thing about buying and selling. Here's the difference. That's the difference. Another thing you have to keep in mind is in the world of options, everything is 100. Everything is 100. What do I mean by that? Every one contract contains 100 shares. So if you sell the one contract of options and they tell you is $1 for the price, what they're saying is that they're paying you $1 per share of those 100 shares for the one contract. So if you see $1, it really means in real money $100. Everything is times 100. So because of that, the stock price matters that you pick. What do I mean by that? Cash secured put pretty much works like this. You pick an expiration date, and let's say a week out. Let's say today's Monday, and I'm going to choose Friday, which is 5 days out. That's my expiration. I choose a strike price. So let's say Apple right now is at 160. I say, hey, as long as Apple doesn't get to 130 by Friday, I want to keep all the money that I get paid. So 130 is the strike you're choosing. The premium you're going to get paid is 1 to 2% on your money. So let's say you have 30K in cash and savings, and that's what you put into the trade. Well, 1% of 30K is $300. So you're going to get paid $300 for that week for executing that trade. Okay. And by Friday, if it doesn't get to 130, even if the stock goes up sideways, in between, upside down, as long as it doesn't go below 130 by Friday in 4 days, you're going to get to keep that $300. That's what I mean by your maximum profit is paid to you up front. But the benefit is you now have a higher likelihood of profit. So this might be a 90% likelihood that this trade is going to get. This might be a 90% likelihood that this is a good trade for you. And guess what? You get to know that up front. That's called delta. Delta tells you the percentage chance of you getting to keep all your premium. If you want to know more about this, I literally did a whole video on options Greeks. I would definitely watch that here and for you to check it out. Okay. So 90% delta means that there's a 90% chance I'm going to keep my $300. But remember, this is every week. So what this really comes out to is about $1,200 a month in passive cash flow 20 or 30K in cash. And you get to do this week after week, month after month. That's the beauty of it. But how do you put on this trade? Well, great question. With your strike being 130, okay, that you chose, you need to be able to buy 100 shares of this because every one contract includes 100 shares. So that means you need 13,000. So 130 times 100 is 13,000. So that means you need 13,000 a year in brokerage to be able to sell even one of these contracts. And for that, if you only have 13,000 in your brokerage, you make about $130, somewhere about 1% on your money. The more cash you have, the more of these you can sell and the more cash flow you can make. So in this example, if you had 100 grand and you're making 1% a week, that means you're going to make about 1K a week or about 5K a month selling and doing this strategy. Because usually these pay somewhere between 1 to 2% every single week for doing this trade. That's why it's called a cash secured put. Because what happens is you're selling a put that's secured by your cash. And every Friday after the trade expires worthless, because we're choosing very short expiration dates, you're going to get to rinse and repeat and do it over again and over again. And the rule is you want to look for deltas of 0.30 or more. A delta of 0.30 says that you are 70% likely to keep all of your premium. And in order to do this, there's a place that every chart has to show you this by law, what the delta is. So you don't have to guess. And then you click it, you see which one makes sense to you. You sell the put, and then you get your premium up front. I know you're going to ask, Josh, what if it gets to 130 by Friday? Great question. The only thing that happens is the cash you have. Guess what? You get to buy the 100 shares. But now you're buying the 100 shares at a cheaper price because it was 160. Now you're buying it at 130. And you still get to keep the cash that you got paid. So that cash of $300 a week you got paid, you still get to keep that. So now your cost basis is lower. This is why I said that people do this for 3 reasons. Number one, to get into stocks they want to buy at a cheaper price and they're getting paid to wait. Number two, they're doing it to generate cash flow, my personal favorite and my reason for doing it. And number three, they're lowering their cost basis into a trade. These are the reasons why people do cash secured puts. But here's something that I will give you as a pro tip. If you want to maximize your chance of just collecting the premium and not getting filled, you want to be doing these trades a lot on ETFs and index funds. On ETFs and index funds. Why ETFs and index funds? Because there's a whole bunch of stocks in these index funds, there's no single stock risk. Meta might dump it for a day. Tesla can dump for a day. Apple get dumped for a day, depending on the use on that particular company. But when you put 500 companies into one ETF and you're selling puts on it, it's relatively stable and one of the easiest way to make sure you're banking that money every single week because there's no stock market risk. So this is one of the beauties of doing cash secured puts. And literally, if you go straight and type in options chain for SOXL, I will show you an example of if I sold, and SOXL is a ETF for the semiconductor company. If I sold puts on it, today's September 3rd, that means Friday is September 5th. So today's Wednesday, that's 2 days away. So even for 2 days, I might not make 1%, but let's go to next week. So I'm going to be in this trade 8 days, May. So if I'm in the trade 8 days, remember, we're selling puts. So we're going to go on the put side and we're going to sell puts on this. And sitting in no puts. I don't know why. So I'm going to log into my brokerage here so we can look at the options chain of one of these companies. And it's going to ask me to log in. So let's hop in and look at one of the options chain. So we look at the options chain, for example, of SOXL here. I just logged into my brokerage so you can see this. For next week, which is September 12th, boom, 9 days away. If I wanted to sell options on this and I sold at the 23 strike price, that means I'm going to make 58 cents per contract, 58 cents. And because options is 100, it really means I'm making 5,800. So for every $23 I have, I'm going to make for every 2,300 I have, I'm going to make $58 on my money. Okay. I got to 2,300 because it's 23 times 100. Remember, everything in the options world is times 100. Since this is times 100, you need to have 23 times 100. That's the cash that you have in your account, 2,300. So for every 2,300, if I'm going to make $58, that's 2.5% on my money. 2.5% of my money. Look at this. 2.52% of my money I'm making for 9 days worth of work. So just imagine if you had 100 grand times 0.2452, that means in 9 days with 100 grand, I'm going to make $2,520. That means in 20 days, I'm going to make about 5,200, give or take, in the same times two. I'm going to make $5,040 on 100 grand. I'm making 5 grand on my money by taking 2 trades a month, selling cash secured puts, and putting money in my pocket. This is the power of cash secured puts. A lot of us have hundreds of thousands of dollars in our brokerage, but we're really bleeding ourselves dry, not making money relatively safely doing this strategy. I personally advise you, if you're not doing this yet, definitely look into it. Cash secured puts is one of the most powerful tools out there. And again, the groups is something you need to understand about this. I'm going to put that video here or here for you to check out. See you soon.